Hey there, welcome to the channel. So today I want to take a look at what's going on with Credit Suisse and is this the Lehman moment? All right. Hey there. So today we have an article here about Credit Suisse. Now, Credit Suisse shares pair losses after earlier plunging as much as 10%. So shares of Credit Suisse swung after earlier plunging as much as 10% today as the Financial Times reported that Swiss bank executives were in talks with its major investors to reassure them, admitting rising concerns over their financial health. So basically, what's happening is the bank's credit default swaps have been kind of rising, and those are a bet. Basically, that goes back to the Big Short, where basically, if you buy a credit default swap, the more that you pay for that indicates how at risk you feel that that institution is at. So, for example, if I wanted to if I wanted to bet against you, then I would buy credit default swaps against you. Okay. And what that would be is like if you have some trouble or you default on the loans covered by those default swaps, then boom, I get a payout. So exactly just watch the big short and is exactly what's going on there. So the thing is, if you look at the charts that have been out there, it's like, okay, we're back to where they were in the crisis. And so now they're also having reports that they're talking about looking to raise capital. So this is what we're going to talk about today. Is this a Lehman moment? Well, let's see. Now, stock market today kind of trying to get back above. Look how it's just trying to hold in there, you know. And then if we look at the daily on Credit Suisse, we see that, it's actually really interesting because there's people that know ahead of this. They know ahead of this. Look, this thing had already sold off last week. Look at that. It had dropped like a stone. So today's little sell off was conceptually nothing compared to what was going on with it last week. Now, a couple other things. This is what I want to do. I want to talk about basically me. Kevin had a video about this and he went through the financials of Credit Suisse. And I agree with his points that, hey, this is a poorly run company. You see that their expenses are going up, even though their income's coming down in the different groups. So basically a piss poor run company, right? Now, the issue though is that if you have a piss poor run company like Tesla or Walmart or something like that, that is not a systemic situation. What we have here is this is a bank. This is a important bank. So all of a sudden it gets a little complicated. So this is from third quarter 2021, and this is the notional amounts derivatives. So this is published by the OCC. So this is a government organization, and what they're doing is they're just reporting the absolute number of basically derivative contracts. Now, there's all kinds of derivative contracts. First of all, note that this is in millions of dollars. So yes, when you're looking at JP Morgan Chase, so they have more derivatives than anyone else. Their total derivatives. Now, this is a factor of leverage. Okay. So let's keep this in mind. This is in millions. So yes, you are looking at that correct. They have 51 trillion in derivatives on 3 trillion of assets. Okay. Citigroup, another guy, 44 trillion in derivatives. Okay. So then followed by this, Goldman Sachs, of course, B of A. Oh, geez, they hold my bank account. Oh, geez, that's nerve wracking. And then down here, one of the positive things you could say is down at number 20 is Credit Suisse. Now, this is USA. Let's see. Is there any other Credit Suisse up here? Okay. So they're at a situation where they are at millions of dollars. So they're at $276 billion of derivatives on $105 billion of assets. So this is what makes this company different. And this is what makes all banks different. And this is what is the issue, just doing a simple financial analysis of a company that's a bank. All those other rules don't apply. The simple fact is these are all the amount of derivatives, and we can see that they have futures. Lots of these are futures. Okay. You have options, forwards, swaps, more options, OTC options versus exchange traded options. Look at the OTCs, 8 trillion in options. You have all kinds of stuff here. And so the point is, what you got going on here is because it's a bank, there's leverage. So this is another way of looking at this. They have 105 and billion in assets, and they have 276 billion in total derivatives. And therefore, if what this is the way that it works, the issue is that they're all betting against each other. Okay. So let's look at that. So I'm bank A, right? So I'm B1 and I'm making all these bets, and I'm making my bets against bank B. Okay. So I'm going to use numbers instead. Bank one versus bank two. So I'm making bets with them. And so what's happening here is they're just putting up little chunks of money and they're exchanging pieces of paper. And what'll happen is, maybe this guy will put up $1 trillion or something, and he'll get a piece of paper in return. And this might be like a swap. Okay. Now, the thing that happens is, if bank two gets into trouble, then the money that you invested in the asset that you have on your balance sheet, the swap, which you're like, oh, this is an asset, and the derivative that you have, you think like, okay, you're going to get paid off. So this is exactly what happened in The Big Short. The issue was that you look at that fund, the fund where it was Mark Baum, right? That character. Now that guy was he was running a fund within Morgan Stanley. At the end of the day, he did not know that he was making all these swap bets for swaps, and they were all coming into the money. He's like, okay, it's all happening, but in the end, he ends up betting against his own bank. Okay, because he didn't know. So this is the problem that we have fundamentally. You have all these big guys, they're all betting. You have 51 trillion in assets. Now, I wouldn't be surprised if half of the 51 trillion in bets is against Citigroup. And therefore, if one of these guys gets in trouble, all of a sudden that the other one becomes in trouble. And the question is why? Now, let's go talk about that for a bit. Now, just for all the people that are looking for, basically nukes in the Ukraine thing, just kind of look this up. Smallest tactical nuke. So they're saying the smallest could be 1 kiloton or less. Okay, that doesn't sound too bad. However, they're talking about using tactical nukes. And basically, when you're talking about tactical nukes, they're saying here it could be a kiloton or less, but they can be as big as 100 kilotons. So we're talking, let's call it between 1 kiloton and 100 kilotons for a tactical nuke. Okay. If that is the case, then what was the bombs that were dropped on Nagasaki? Well, there was 15 kilotons into 20 kilotons. So if you're thinking that, oh, a tactical nuke being used is like not going to escalate, well, you got another thing coming. So the issue that you have with banks and why there's so much concern over any bank having trouble is that, as I pointed out, when you're looking at that derivative data, there's only so many banks and institutions that those bets can be made with. And the reality of the situation is, and what we found out in the financial crisis is that it turns out that there really aren't that many entities that could be making these bets. So if you have any one of these major banks in trouble, there are people that have money at their banks. They have people betting against them that could be thinking their position is in the money, but you're not going to get paid off. Exactly the risk that in the Big Short movie with Mark Baum was facing. It's like, hey, look, if you're betting against Morgan Stanley and Morgan Stanley goes bankrupt, you're just a creditor. So you could have been the smartest person in the room, made the best bet ever, but you know what? You're going to lose. You're not going to get paid off. And so this is one of the issues. And also with the banks, which you saw in Lehman and Burn Stairs, like there's all these accounts and all this money moving around. And the problem is that you lose control of that money. If for whatever reason a bank went bankrupt and you had money over there, even if it's your money, it was in transfer, it was being held as a third party, blah, blah, blah. And we know this from the crypto stuff that's been going on. You have a risk of not losing access to that money. And if the money was in some kind of a bet with them, some kind of a derivative, then you're just not going to get paid. And that's what the risk is. So when you see the credit default swaps go up like that, that's what the concern is. So it's a very interesting day. You have like the market kind of rallied up a little bit. You got this concern going on about Credit Suisse and the, people try not to worry about it, but it is a big worry. Now, here's the problem as well: is that so we always have this issue of, they always have this saying that generals are always fighting the last war. And this is, very important thing, that we need to keep in mind as well. So what does that mean? Well, okay, let's say you're fighting World War One, right? Okay, you're fighting World War One. What was that war? That war was a very defensive. Defense always ruled in that. I mean, that's basically how you won. You just had defense until the other side just ran out of resources. It was a war of attrition. Okay, so now you have generals. So in particular, you could look at maybe generals in France and stuff that kind of had this mindset. It's like, okay, we're going to build this wall, the Maginot Line, and we're going to use that because it's going to give us a good defensive position, which is what basically helped us win the First World War. Now, come to the Second World War, and all of a sudden, it was not a static war at all. It totally changed. It became a dynamic war where it's like, oh no, you're sitting there in the Maginot Line, and tanks and armor have moved at 20 miles a day behind your lines. All of a sudden, all those static defenses, which were incredibly valuable during World War One, are now worthless in World War Two, and hence you instantly lose. And so that is the risk here of making this kind of comparison with Credit Suisse. But so we have a point and a counterpoint. Number one, we still know that all these banks have incredible, 52 trillion in notional value of derivatives. And we know that they all bet with each other. Okay. We know then that they're all interconnected. If one of them in the top 20 has financial problems and goes out, we know from what happened in Bear Stearns Lehman that can create a cascading effect. There's another issue about whether they can call, whatever, but we know that it has effects. So that's the pro side to say this is a Lehman moment and the financial system's going to crash. All right. Well, I think that is it for this one. It's surprising that we're in this situation again. It's surprising that maybe very little has changed. All right. Bye.